Good evening, everybody, and welcome to our market review webinar. Guys, I hope you have all had a fantastic weekend and are all refreshed and ready for the week ahead. We've got some fantastic movements taking place within the markets at the moment, and we're going to look to capitalize on those movements. But before we get into the week ahead, let's look at last week and refresh ourselves and remind ourselves of last week's fundamental events and, of course, from our planned trade positions. So last week, guys, we had two positions that we would be analyzing and managing. So we had the previous position with the euro Japanese yen. This was a short position that we were looking to average into this this price movement. So by averaging to the price movement, what we were looking to do in this instance, we were looking to split the risk over those two potential positions. So one of our entries was triggered, and this did meet the expectation on the market just shortly after the market opened last Sunday, after President Donald Trump's comments regarding the US-China trade war. So we have secured 155 pips off of our first entry and the profit target. This netted us around 3-to-1 return on our trade position. So for myself, you know, as mentioned, I was halving my risk per position over those two entries. So I only risked half of what I usually would over the first entry, and of course that triggered and met the expectation. But still, some fantastic profits there made off of that euro yen short movement. So guys, before we get started and look at last week's fundamentals, does anybody have any questions for me? Just pop a message into the box if you have any questions, and of course we'll answer those before we continue. If you don't have any questions, not a problem. We will get straight into it and take a look to the week ahead. Sorry, the week behind, and then we'll analyze the potential week ahead. So last week started off quite volatile from the market open. We saw huge strengthening across the Japanese yen, and this was brought on as a result of Donald Trump's comments regarding the US-China trade war. So talks were initially seeming to go quite well, and they were being reported as progressing steadily and consistently. However, Donald Trump made the announcement, of course, via Twitter, that negotiations had gone pretty stale, and due to that lack of progression, Donald Trump feels like it's a lack of willingness to get the deal over the line. So he mentioned that he would put tariffs up from the current 20% to 25% on $200 billion worth of goods. So this, of course, as a result, saw some large-scale uncertainty within the markets last week, and we saw the Japanese yen strengthen quite significantly over the market open as a result of this news. We saw the S&P 500 and the Dow Jones both take huge losses from that market open and from that data release as well. So it started off to a very volatile week last week, and we were on the right side of that volatility, and that's what closed our euro yen position for us. So with that aside, it was already quite a volatile day moving into Monday. Into towards Monday evening, we had Governor Poloz was speaking again, and he was due to speak about the future of Canada's mortgage market at an event co-hosted by the Canadian Credit Union Association and Winnipeg Chamber of Commerce. So it wasn't anything specific to do with monetary policy, specific to do with the current Canadian economic climate. It wasn't anything specific to do with the central bank. He was merely making remarks at an event. So it was very unlikely that we were going to see major market movements as a result of this data release. And you know, it was pretty steady there for the Canadian dollar. Moving into Tuesday, it was a little bit more uncertain. So what we saw was that it was expected for us to see the Reserve Bank of Australia lower interest rates to 1.25%. So this was one of the pieces that we highlighted last week that could potentially create some large-scale volatility. And we did mention about the potential direction of this data as well. So what we were expecting is we were expecting the Reserve Bank of the Reserve Bank of Australia to decrease rates by 25 basis points from 1.5% to 1.25%. This was widely expected to take place at this meeting. However, we didn't see the central bank act, which was kind of unusual, kind of unexpected, given the current market climate. It wouldn't have been a surprise to see the central bank cut interest rates by 25 basis points. Almost, or we'll say the majority of central banks are very dovish at the moment. They're very bearish, and this is due to this poor global economic data. So it was expected to be fairly dovish, but ultimately keeping the interest rates at 1.5% is a very bullish statement from the Reserve Bank of New Zealand. And as a result of that hawkish, it's a very hawkish statement, and as a result of that hawkish statement, we saw the buyers come back into the market over the Aussie dollar, and we saw some very powerful bullish momentum movements. So we were aware that this was likely to cause volatility within the market. We did speak about the potential direction, and we mentioned that there was a potential for upside. There was upside potential for this data release, mostly because it had already been priced in to the market. It was, as mentioned, it was widely expected for the Aussie dollar to the Aussie central bank to cut interest rates. So this was somewhat already priced into the market and had caused some weakness with the Australian dollar. So when it came out that actually, in fact, the central bank were keeping rates at 1.5%, the buyers came back into the market, and we had that new piece of information priced into the market, and as a result, the buying pressure, it was very, very powerful from this data release. So this was also coupled beforehand with positive retail sales month-on-month data, but we didn't really see too much reaction there with the Aussie dollar. The market was waiting for that cash rate and the rate statement from the Reserve Bank of Australia. We also had inflation expectations quarter on quarter for the New Zealand dollar, and this was remained fairly consistent at 2%. Moving into Wednesday, we had the official cash rate for the Reserve Bank of New Zealand. And they did act upon their monetary policy, and it was an unexpected act by the central bank. The interest rate was previously at 1.75%. It had been at 1.75% for quite some time. They were talking probably about six quarters, so about a year and a half, maybe even a bit longer than that. So it wasn't expected that the central bank would change their monetary policy stance, but given the nature of the global macroeconomics, and given the state of the well, I suppose the state isn't the right word, but given the condition of the New Zealand economy, it did make sense for them to lower interest rates, because the New Zealand economy now has been fairly slow, fairly stagnant in terms of growth for, off the top of my head, for about the past 6-7 months now. It's been really quite poor and inconsistent in terms of data, and we haven't seen much reason to be bullish. So the central bank have now taken action, and what we are likely to see is prolonged movements to the downside while the market prices in this new piece of information. So we are likely to see the sellers come back into the market and push prices to the downside. Ultimately, what they are expecting in the medium, in the mid to long term, is for this lowered interest rate to help assist the economy. So it will entice people to spend more money. Of course, they'll be getting lower interest rates on their loans, on their mortgage applications, and of course there's less incentive to save, because you're not getting that interest, that high interest rate on your savings with the bank. So it's expected, of course, to help the New Zealand economy in the long term, but in the short term we should have some good selling opportunities. So again, another piece of information that we identified that would have some potential impact within the markets, and once again we did see some large volatility there with the New Zealand dollar. Into Wednesday afternoon, we had a speech by ECB President Mario Draghi. He was due to speak at the Generation Euro Students Awards in Frankfurt. Again, guys, what we're looking for when these governors of the central banks are speaking is we're looking for that phrase, monetary policy. We know if it's to do with monetary policy, then we can expect volatility, like we had with the Aussie dollar and the New Zealand dollar earlier last week. You know, those changes in monetary policy saw very powerful movements. So when a central bank manager is speaking, that is where our attention lies. Is the central bank manager, is the central bank governor sorry guys, I lost you for a second there. My Wi-Fi had a little blip. But what we're looking for is the central bank governor speaking about monetary policy? Because if he's speaking about monetary policy, then it's likely that we could see volatility within that currency over its respective currency counterparts. So it wasn't to do with monetary policy. We didn't expect much volatility, and we didn't get that much volatility from this data release. Moving into Thursday, we had trade balance data for the Canadian dollar. This had remained pretty consistent. The figure had decreased, but not at the rate which economists had forecast. So we did see a slight reduction from the previous figure, but nowhere near that minus 2.4 billion forecast. Moving into the US dollar, we had PPI month-on-month data. This was pretty consistent at 0.2%. Sorry, this came in at estimation at 0.2%, and we were expecting a fall from that previous 0.6%. I believe that, yeah, that 0.6% was quite an anomaly in terms of data. We saw fantastic figures there for April, but consistent. Really, the average has been around 0%, maybe 0.1%, and now we're seeing figures going back down to those forecasted levels. So again, guys, we're still not seeing that consistent positive US dollar data that we want to see before we can start to look to buy the dollar on a long-term basis. Okay, but I still think there's going to be some good opportunities on a short-term basis for the US dollar. And moving into Friday, we had the Reserve Bank of Australia monetary policy statement, which had reflected their decision to keep rates at 1.5% instead of moving rates down 25 basis points to the forecasted level of 1.25%. Within the monetary policy statement, they provided their reasoning for not doing so. We won't go into too much detail with that. Otherwise, guys, we'll be here for a couple of hours, and I don't want to keep you too late on your Sunday evening. So into Friday morning, we had some data for the pound sterling. GDP month on month came in disappointing at minus 0.1%. It had been pretty positive. Data, well, for the pound has been pretty positive. And it's been pretty consistent now over the past 2, 3, maybe even 4 months. Or, well, even so far for 2019, the data for the pound has been so far quite impressive. But we're just seeing GDP figures take a slide below 0% into that negative territory. But you know, we've seen a little bit of a decline from 0.5% to 0.2, and now into these negative figures. But I would expect this to only be temporary, and I would expect to see figures back up towards, you know, that 0.2% mark next month. Manufacturing production month on month again held its consistency. We're starting to see some fantastic data coming together now for the second quarter. We're averaging 0.9%, which is fantastic. And even these previous figures have been revised up. Previously, 0.8, that was revised up to 1.1%. 0.9, that was revised up to 1%. And again, we're seeing figures in at 0.9. So, you know, for the second quarter, we're averaging 0.9, 0.95% for manufacturing production month on month. And again, we're seeing some very strong data there for the pound. And of course, the prelim GDP quarter on quarter. So despite that decrease month on month, it hasn't had too much effect to the macro forecast and the macro outlooks. What we would have, maybe seen if we had had some disappointing figures before this this data release. If we had seen, you know, maybe slightly more disappointing figures for 2019, then maybe the prelim GDP quarter on quarter would be a little bit more disappointing, failing to meet the forecast. But as it stands, the previous months bullish data has steadied the macro picture, and the UK remains on forecast in terms of GDP. So moving into the afternoon, we had data for the Canadian dollar in form of employment change data and unemployment rate data. We saw monster figures for employment change data for the Canadian dollar, up at 106,000, 90,000, 95,000 more than, just under 95,000 more than forecast. We saw some absolute fantastic figures there, and ultimately, you know, these brilliant figures coming in at 106,000 contributed to a slightly better unemployment rate than expected. The macro picture was at 5.8%, but the figures that we saw pushed it down to 5.7%. So some positive data starting to be pieced together for the Canadian economy, and this is something that I'm keeping an eye on to see if we can get some consistency with this data release. So that catches us up for. Oh, sorry, just the US dollar data. We had CPI month on month and core CPI month on month for the US dollar as well. So CPI data month on month coming in at 2.1%, just under estimate of the previous estimate of. So just coming under the estimate at 0.4%, coming in at 0.3%. So some slightly disappointing figures there for the US dollar, and core CPI ultimately just showing some slight positivity, just remaining above that 0% figure, and showing no change on last month's figure. So guys, do any of you have any questions for me about last week's fundamentals? If you do, just pop a message into the box and we can go through those questions before we move on. If you don't have any questions, not to worry. We can look to the week ahead and then look on to some charts. Okay. So far this weekend, guys, it's been hasn't been too much of a volatile weekend. We haven't had any major unscheduled announcements take place. It's been fairly quiet, fairly steady. Even Donald Trump has been away from Twitter and not contributing to the volatility in the markets. Nothing like what we saw last week. So it's been a pretty quiet weekend in terms of that. So I wouldn't expect any major gaps upon markets open. I would expect everything to be, back to usual as far as usual goes in the markets. So I wouldn't expect any gaps to be forming from the markets open. So it looks as though we'll have a steady start to the week, a steady start on Monday. We do have the Assistant Governor of the Reserve Bank of Australia addressing the market. And we also have an FOMC member addressing the market. I'm just going to take a look of what they have. Due to participate in a panel discussion entitled "The End of LIBOR and the Impact on Australian Financial Markets," we might see a little bit of volatility off of the back of that, but nothing that can't be managed in a position. I wouldn't expect to see 15, 20, 30, 40 bit movements off of this. This is, we may see on the smaller time frames a slightly stronger or slightly weaker, more so than usual candles, but it's not going to be major movements. We're going to see maybe sort of 4, 5, 6 pip movements off of something like this. Okay, so let's take a look at FOMC member Clarida speaking. Due to deliver opening remarks at an event hosted by the Federal Reserve Bank of Boston, we're not going to see any. I wouldn't expect to see any major movements here, and this is why. So, if we compare the two data releases, the first one is due to take part in a discussion titled "The End of LIBOR and the Impact on Financial Markets." So LIBOR was the interbank lending rates, the rates which were agreed, and banks tried to keep these rates at certain levels, so that banks would lend to each other at certain rates. But of course, we saw how the LIBOR markets were manipulated by big, large tier 1 banks, and that did contribute to the last major financial crash. So something like this could potentially move the markets due to its nature. But on the other hand, with the FOMC, we have just due to open the event, if you like, due to make opening remarks at the event. So there won't be there won't be any major financial discussion. It will be a much more informal meeting. It will be along the lines of welcome everybody to to the annual so-and-so event at the Federal Reserve Bank of Boston. It's my pleasure to welcome you all here, etc., etc., etc. So it's unlikely that we're going to see any major volatility there on the Monday. Moving into Tuesday, though, we do have average earnings index 3 months on the year for the pound. This has been defying really, sort of global averages, and wages have been showing some fantastic increases. But not only has it been fantastic increases, it's been very consistent as well. We've seen figures there for the year averaging 3.4%, 3.4, 3.4, 3.4, 3.5, and we're not expecting any change there. So I would expect some bullish market behavior over the pound from this data release, but that is dependent, of course, on Brexit. On Brexit updates. If we have bearish Brexit updates released to the market, I don't think the average earnings index is going to do too much or influence too much buying pressure, as the Brexit announcement will take priority. So as long as we don't have any Brexit announcements, there should be some good bullish behaviour there for the pound throughout Tuesday. Providing we hit that consistency of 3.4% on average earnings. Moving into Wednesday, we have wage price index quarter on quarter for the Australian dollar. This is expected at 0.6%, a slight climb on last quarter's figure of 0.5%. So we are expected to see some slight positivity within the Australian economy, but I think next week it could be, quite a bearish week for the Aussie dollar. Quite a bullish week for the Aussie dollar, given the monetary policy decision. Given that they decided to keep rates at 1.5%. So I think the Aussie dollar is going to be quite volatile next week anyway. Moving into the afternoon, we have inflation data there month on month for the Canadian dollar. No change expected there. We don't have our forecasts coming in, but the forecasts were, have been pretty consistent for the past few months, and we're not really expected any change there. I believe the forecast is around 0.6%. So again, not the most positive data there for the Canadian economy, but does have the opportunity to show a little bit of consistency. Retail sales and core retail sales for the US dollar. Previous retail sales data was exceptional at 1.6%. The forecasts are down towards 0.2% at present. So we're expecting some fairly disappointing figures here. And again, that is reinforcing the macro view of the US dollar. We're not seeing too much consistency for the US dollar for us to start looking at macro positions and maybe looking at the euro dollar below 110. For the meantime, I think that 110.50 is going to be quite a strong barrier. I do believe that we will see the euro dollar move down to that level, down towards the 110 level. But until we start seeing some consistent dollar data, I doubt we're going to see sub 110 just yet. So there's plenty short-term potential there moving ahead with the US dollar, but we need to be a little bit patient to wait for those macro opportunities. Employment change and unemployment rate data are expected for the Australian dollar. This has been pretty steady for the year so far, albeit apart from March, you know, fairly disappointing month there in terms of employment, but again, you know, we're sitting quite healthily above the average, and you know, it's all of these factors. You know, the consistent positive employment change data. You know, it's these factors that the Reserve Bank of Australia took into account, you know, before making that decision to leave rates unchanged. If we didn't have this positive data in some areas of the economy, then you know, we definitely would have seen that decrease in the interest rates for the Aussie dollar. So you know, it's not just over yet for the Australian dollar. I think if we start to see some negative data coming back into the economy, then you know, ultimately we will see them move rates from 1.5 to 1.25%. But if we start to see a little bit of buoyancy within these data releases, and we start to see a little bit of positive data, so just keeping our heads above the water, then you know, we will start to see the Australian dollar take that into account, and then rates could remain steady at 1.5%. So I think it's going to be quite a volatile week next week for the Aussie dollar, given the data releases that are expected. I think if we didn't have all of this data expected, you know, for the Aussie dollar, I think we would you know, maybe see some much nicer bullish price action. But you know, with this barrage of data, if we start to see some consistency in negative data, then you know, I think the Aussie dollar is quite susceptible to a sell-off. So moving into Thursday afternoon, we have Governor Poloz speaking for the Bank of Canada. He is due to hold a press conference about the financial system review in Ottawa. So we could see some volatility off of the back of this event. I wouldn't really. So with this data release, guys, where he is due to speak about the financial system review, it is, you know, there is a potential that he could mention monetary policy. Given the Canadian economy was close to adjusting their monetary policy recently, you know, we could see we could see some volatility off of this event on Thursday afternoon. So just be a little bit careful there with the Bank of Canada, please, guys. And then the following Saturday, we have the parliamentary elections in Australia. So, you know, guys, if you are in any Aussie dollar positions, look to close them up before the end of the week. Well, that's what I will be doing myself. I'll be looking to close up my positions because, you know, depending on the outcome of those elections, we could see some, you know, some uncertainty with the Australian dollar, and where it's over the weekend, we could see some gaps on the market open next week. So, the week after, the following week. So, you know, just bear that in mind there, guys. So, looking at the week as a whole, we don't really have anything really too major to be too concerned about. The average earnings data for the pound will be quite interesting. If we don't see that that consistency in the figures up at 3.4, 3.5%, if we do start to see a dip down towards 3%, then we may see the pound sterling start to sell off, you know, quite powerfully. But I would expect the positive data to continue for the pound. It's been a fantastic start to the year, and you know, despite of Brexit, the UK economy is performing well. So I would expect that to continue for the UK. So guys, moving into the week ahead, do any of you have any questions for me before we get started, guys? Before we go on to the charts. Okay, fantastic. So, guys, I'm back to using MetaTrader for this week's webinar, because I was having a few issues with TradingView earlier today, and I didn't want to take the risk that, you know, we'd be sat there trying to get TradingView to work when you know, we know that MetaTrader is going to load up and is going to be fine. So for me, guys, I was looking at the daily structure that's being created on the Euro US dollar, because I think at present we're at a bit of an interesting area in price. We created this lower low down towards that 111.10s. We saw a bullish engulfing candle there down at the lows. It wasn't that convincing, but the buyers came back into the market and pushed up to that 12.50 price level. Now, if you can see on the daily time frame there, what we are doing is we're creating quite a nice structure on the way down, and it had been quite consistent. There was a fundamental influence here that ultimately broke the previous high, but what we had been seeing was these series of lower highs and these series of lower lows, indicating that the sellers are quite firmly in control. So if you notice, we've came back up to that 112.50 price level once again, and you know, we've been testing this price level now for just over a week or so, and the sellers have come in and defended this level each time. And if we go down onto the smaller time frame, we can see, you know, from that 112.50 how the sellers have came in to the market so far this week. And, you know, first of all, we did break that high. We broke the previous swing high, and you know, we saw a huge rejection off of that candle, and this is over the 4 hours. So, you know, we saw a huge price movement to the downside. There's a lot of supply coming into that market, and once again, you know, the 4 hour candle touching that supply at 112.50, and, you know, finding the closer candle at 112.10 before staggering back up to that price area. So for me, guys, I'm looking at the 112.50 as a potential area to take advantage of this supply within the markets. You know, we've seen, especially over last week, that really over the past 2 weeks, that when we approach that 12.50 price level, the sellers come back into the market quite convincingly, and the supply overwhelms the demand, and we see lower prices. So I would expect history to continue, and I would expect the sellers to overwhelm the buyers once again at that 112.50 price level. So for me, it offers a fantastic opportunity for a sell limit position. So where we are on to the label. So what I'm looking for, guys, is sell limits
and I'm looking at that 112.50 price level. So just going to get that entry marked up. 112.50 at that area of supply where we've seen the sellers come back into the market and clearly overwhelm the buyers. So what am I looking at for a stop then? Well, if we've got this structure on a daily of these these lower lows and these lower highs, we've got this bearish price structure in place, then it would make sense for me to put my stop above the previous market structure high. Now, we could use this stop just above the 112.50 from that previous rejection candle. However, you know, it is still creating this high. So we would have to go back to the 113 handle and look to use these prices over at this level. And the 113 offered us some fantastic opportunities to short the euro dollar, and it has offered us some great opportunities throughout the year to short from that level. So given the supply that's came into the market at 112.50, you know, and the supply that's came in at 113.08, I think these offer us some good price areas that we can utilize. So we've utilized the 112.50 for our entry. For my stop, I'm going to look to place that above the 113.08. So above the 113 handle, that's around 113.10. Give me about 60 pip stop loss for this trade position. So what have we got? We've got stop loss to be placed at 113.10. And it does give us a slightly bigger stop, and I know you may be looking at that thinking, well, you know, the stop above 112.50, about 112.80 from this huge rejection candle, it could possibly, you know, it is likely to hold, but you know, I think the 113.10 gives us a much safer stop for the position, and ultimately I don't want to take a loss and then to see the price move on in accordance with our expectations. So we'll give it a little bit of room, about 60 pips for the trade position, but what I am expecting is that move back down to the 111 handle and ultimately moving through that 111 handle. So what I'm going to do at the moment is just take us back onto the daily, compress the chart and move to the side. There we are, that 110.80 price level as well. It's quite a significant price level. Sorry, down to the 110.50s as well. There's a bit of a zone down that area. So looking at a previous price at 110.80 does look, you know, there are some good price movements and price reactions off of that level. So I might be tempted to use that 110.80 instead of looking down, you know, even further to the 110.20s. Again, you know, and we don't want to take it onto too much of a macro basis until we start to see that data. So, you know, with that in mind, I'm going to look down to just below the 111.10s down to the 110.80. And if the structure remains intact for these lower lows and lower highs, then our profit target should be met very comfortably. The profit target at 110, let's go just above 110.85 at 110.90, giving us a potential profit of 160 pips for this position with a 60 pip stop loss. So looking at about 2.5%, 2.5 to 1 One, of course, being our risk, 1 unit of risk, and standing to make 2.5 times our risk if the position meets the expectation. So we have a fantastic position there on the euro US dollar. Just to go over it once again, looking to place a sell limit at that supply level at 112.50. For my stop loss for the protection for this position, I'll look to place that above the 113.08 significant price. Looking at 113.10, which is around the previous market structure highs set back in mid-April. And then for my expectation, of course, I'm looking to take profit just below, just before that 110.80 significant price level, which, you know, I would expect the market to hit quite comfortably. I would expect these lows to be broken and for that market structure to continue over the next few days, maybe over the next couple of weeks. So guys, we've just banked 155 pips from our euro yen that met last week. Let's see if we can do slightly better and net the 160 from this euro US dollar position. Guys, do you have any questions for me about this evening's webinar? Just pop a yes in the box if you do. Don't worry if you don't have any questions. And likewise, guys, you know, if you do have questions, but you know, you want to remain anonymous, then, you know, you're more than welcome to write a question and just put anon at the end of it, so ANON, and that way I'll know that you know, you want to be kept anonymous while I'm asking that question. I've found that's you know, a good practice for helping people learn. Sometimes people can be a little bit shy, which is understandable, you know, but if we've got a bit of anonymity with it, and you know, we're not going to be pulled up on that personally, then, you know, I find people are a little bit more comfortable with asking questions. So if you do ever want to ask a question, guys, and you don't want to you know, have your name be mentioned with that question, then all you have to do is just put anon, and I'll keep your name out of the question. So no questions, guys. I guess I have done a fantastic job for this week, and we are all understanding clearly what you know, we expect for the week ahead. But no, seriously, guys, you know, if you do have any questions and you think, oh, I should have asked Matt that, then, you know, please don't hesitate to give me a message, and you know, we can go through that question together. Likewise, in the webinars, if you know, if you're thinking about asking a question, I really do encourage it, guys, because when you ask that question, number one, there's the weight off of your shoulder now because you've asked a question, and ultimately it's how we learn, by asking questions to learn answers that we don't know yet. So I do always encourage questions, guys. So you know, please don't hesitate to send them over. So guys, that wraps it up for this week. Very well done this evening. I will see you all back here next Sunday evening, where we should be, if all goes to expectation, you know, discussing last week's profitable position, or this week's profitable position on the euro dollar, sorry. thank you all for attending this evening, guys. I wish you all the very best. Have a fantastic week. Take care and goodbye for now. Thanks again, guys. Take care and bye for now.